session basically will be purely theoretical. We are looking at the theory questions that so many of you disregard. And then at the end of the day, you get very, very good marks being provided in your exam. If you are not very good with these theory areas, then you fail, all right? So your exams, ladies and gentlemen, will always have so many theory marks, up to 30, at times even 35%. So if you're very good with theory, and then of course you add that up with some computational areas, automatically, like group cash flow, not group, but group consolidation, then we have in this case here cash flow statements, a few areas here on partnership, etc. I'll be able to guide you on that, but for this session, I'm basically looking at the theory areas. And here we are. Just a moment. All right. So the first question that I would want us to look at, all these questions are from your past papers, and I would want us to start right away with this question on distinction between adjusting and non-adjusting events. Adjusting and non-adjusting events. And I'll be able to give you stories, ladies and gentlemen. For those of you who have never met this Chief Ninja, my name is Dr. Joshua Aura. I work at two places, RCM Online College. I teach here so many papers. You'll be getting me at the advanced level. And then, of course, I work for Aura and a company, a firm of certified public accountants. We are auditors, we are tax consultants, and we do advisory. Now, ladies and gentlemen, in my auditing world, normally what happens, you will get, like currently we are doing auditing for KMPDU, Kenya Medical Practitioners Dentist Union, right? So then what happens, these guys have done their financial statements, in this case here, for the last year, all right? They have done their financial statements for last year, for 2024. And you see now they would want us to provide assurance to all their stakeholders that those financial statements are correct. They present a true stroke fair view. Now you see they are giving us these statements in January, they're giving us these statements in January. Please listen first of all before we talk about that. So they have given us these financial statements in January 2025. And of course, they will give us like 2 months to dig information, to be able to get evidence. Evidence in this case here that we shall be able to rely on to provide our opinion. So now listen, we shall be able to give them this opinion by the end of, say, March. By the end of March. Sorry, there is some noise background here. Just a minute. All right. Okay. So just a minute. All right. Now, ladies and gentlemen, please listen. So one thing that we shall be able to realize when we are auditing books will be this IAS number 10, the concept of adjusting and non-adjusting events. How does this work really? It works in a very, very easy way. So, you know, for example, in their financial statements, they have told us that we have receivables of, say, 20 million. That is at 31st December 2024. They have receivables of 10 million. And then come February of 2025, when I'm doing auditing, on the news, I see one of their one of the people who owe them, one of their receivables has been declared bankrupt. So then if this person has been declared bankrupt, what does it mean? He will not be able to pay this receivable. He will not be able to honor his obligation. Now we'll have to ask ourselves, in this case here, these receivables of say 5 million, this guy has died with our 5 million. Do we go back to this particular client of ours and tell our client, you know, now your receivables are not correct. Please adjust them. Reduce your receivables by say 5 million because there is one client here who has been adjudged bankrupt. Ladies and gentlemen, for receivables, of course, that will be an adjusting event. We would want the client to adjust because this thing of being declared bankrupt is not a single day thing. By the time you are being declared bankrupt, automatically bankruptcy is something that may have even begun like 2 years ago. So it means that this particular receivables figure in your 31st December financial statement, that figure was just in this case here supposed to be reduced by that date. We are only getting a confirmation in February 2025 that that figure ought to have been reduced. So then that automatically means that that receivables becomes what we call adjusting event. It becomes what we call adjusting event. Please listen. Events after the reporting date, after 31st December 2024. All right, I'm using 2024 because that is the year that we have just finished. Now we are auditing books of 2024. Also called subsequent events are events that occur between the end of the reporting period and the date when the financial statements are authorized for issue. When we are auditing them, basically, they are classified into two. We have adjusting events and non-adjusting events. Adjusting events, events that provide additional evidence. They provide additional evidence of conditions that existed at the reporting date. Very good example is a settlement of a court case confirming a liability existing at the year end. Ladies and gentlemen, please listen and listen to me very well. We have ended our financial year 2024. Those books of accounts and the financial statements have been given to the auditor in the first quarter of 2025. In this first quarter, our client had what here? A case in court. At around March, beginning of March, we have in this case here that judge lifting his hammer and saying that our client was on the wrong, and therefore he gives a fine. You see, that fine automatically is a liability. And this liability, of course, chances are it wasn't factored in the financial statements of 2024. Many clients would not want to factor those kind of obligations before the judge pronounces himself. Of course, you have those things of probable etc. But many clients have been in this industry for long. Many clients will not be able to do that. So once in this case here, this judge says, hey, there is a fine of 20 million. Then I'll be able to call my company, my client, ask my client, when did this case begin? The case began, for example, in 2023. So it means that this particular liability existed long time ago, and therefore I will call upon them and tell them that, hey, there is a misstatement. There is a missed statement. Please go ahead and have your financial statements back and include a liability of 20 million. And of course, depending on how we structure this liability with the person who had sued us, that liability could either be current or non-current. In most cases, court fines are current because you'll be required to pay like immediately. You'll be required to pay immediately. Then that becomes an event that must be adjusted. The client must change their financial statements. Because basically, even if it has happened in 2024, please understand, even if it has happened in 2025, this 2025 happening is basically confirming a condition that existed. The case has been with these people for a long time. Are we together, ladies and gentlemen? Have you been able now to understand how this concept of adjusting event is supposed to be explained in your own language? Have you been able to pick it up? Is there somebody who has been able to pick it up? All right. Now, please, there are also events that we call what here? Non-adjusting. Non-adjusting, these are events that relate to conditions that arose after the reporting date. If the event has arisen after the reporting date, it was not there earlier on. These guys have given us their financial statements of 2024. We are auditing them in the first quarter of 2025. And then, of course, we have like their accounting department getting burnt down in 2025 February. You see, that building was there at the end of the year. That building on 31st December 2024, the building was there. So coming to tell these people that, hey, please remove this building's value from your PPE because the building got burnt down, that will be a wrong thing for me as an accountant to advise them like that. Because you see, the house was existing in 2024, end of 2024. This house has just been burnt down in 2025. So in this case here, we can only look at what we call prospectively, going forward. Here we cannot handle it retrospectively. Yeah, because this building in 2024, end of 2024, the building was there. And it means that the financial statements that had the full building's figure at the end of 2024 was correct. So I cannot ask those guys to amend because that building was there. They have represented the true position that that building was there at that particular end period. So then that becomes non-adjusting. That cannot be adjusted. So non-adjusting events, events that relate to conditions that arose after, they have arisen after the reporting date, like fire damaging assets after year end, business combinations like that. If we come and do mergers and acquisitions in 2025, we don't expect those figures to affect our 2024. So then what are the accounting treatments of events after the reporting date? Adjusting. These are reflected in the financial statements of last year because you have to tell them to change. The financials are adjusted to reflect the new information. If they refuse to change those financial statements, I shall qualify my opinion as an auditor. Then on adjusting events, these are not adjusted in the financial statements. If they are very, very material, like for example, the one of our offices being burnt down, then we have to disclose them in the notes. If they are material, we have to disclose them in the notes. And basically, what IAS 10 tells us is to state the nature of the event, and then we give them an estimate of the financial effect. This building that got burnt down was our office block. And of course, it is valued this much. And this is how we expect the property, plant, and equipment to go down. All effects must be shown. They came and asked us the other day a question on international public sector accounting standard number 14, which also talks about what are subsequent events after our year end. So the same here. They also have, IPSAS is for public sector, the government, parastatals, public sector. According to IPSAS 14, events after reporting date, also subsequent events, are classified into two. Adjusting events, these are events that provide evidence of conditions that existed at the reporting date. They require adjustments to the financial statements. Non-adjusting events, these are events that indicate conditions that arose after the reporting date. They do not require adjustments, but may require what you disclosure. I believe that one, ladies and gentlemen, is good enough. So you should not be intimidated when you see them quoting like IPSAS 14. It is just the same thing. Remember, we're very lucky nowadays because there is this natural trend of IPSAs and the IISs and the IFRSs going towards the same direction, using the same definitions. Most students fail financial reporting because of these theories. And these theories, normally the trick is, number one, we must write something. Even if we don't understand, we shall not leave our booklets blank. And once in this case you have got an idea, even from IFRS, from ISS, and then these guys here come and ask you something that is quite similar, but now relating to IPSAS, just borrow the concepts here from IFRS, and then you'll be able to just pass. For the number of years I've marked these papers, ladies and gentlemen, I realize that there are those situations where students, on seeing the word IPSAS, International Public Sector Accounting Standards, in this case here, they simply cannot answer anything. No, that shall not happen to us. This semester, we shall be able to answer all the theory questions and ensure you get over 30. There are very good examples. I've shared this handout with you. Ladies and gentlemen, here they came and asked us something on IAS 12. Distinguish between taxable temporary differences and deductible temporary differences. When we talk of taxable temporary differences, of course, these are those differences. The difference is just temporary, but in this case, you have gained. It's a gain. And of course, all gains that you get in a company, you must pay tax on them. So whenever you hear of taxable temporary differences, these are differences that will result in taxable amounts, in gains. Taxable amounts are gains in the future when the carrying amount of an asset or liability is recovered or settled. Example, accelerated tax depreciation versus accounting what year? Depreciation. I'll be able to explain this very well. But ladies and gentlemen, remember at the end of the day, if this temporary difference is taxable, they always result in a gain. And you'll be required in this case, you have to do what? You have to pay tax in the future. For taxable temporary differences, in this case here, you have your TB, tax base, your carrying amount. When you subtract them, there is a difference you will get. If this difference is a gain to you, then automatically you will pay tax on it in future. So if you will be paying tax on it in future, then that difference will be called taxable, a taxable temporary difference. It is different from deductible because now deductible, you are making a loss which is tax allowable. If you make a loss when you are subtracting carrying amounts and tax basis, when you're subtracting and you're making a loss, and this loss is allowable, then, ladies and gentlemen, we'll be making savings in future. And you'll be making savings in the future, then that temporary difference will be called deductible. So deductible temporary differences are differences that will result in deductions from the word deductions or tax savings in the future when the carrying amount of an asset or liability is recovered. Ladies and gentlemen, please listen and listen to me very well. You don't have to cram these things word by word. No. I would even want to be seeing all my students writing these concepts down in the language that they understand best. Like if it's me, if you talk about, for example, taxable temporary differences, I'm able to know straight away that it is only gains which can be taxed. So a taxable temporary difference is any difference that results to a gain, which in the future, this particular company will be required to pay tax on. So this gain is what we call, it results in a taxable amount. Deductible temporary difference, that particular difference between carrying amount and tax base. Carrying amount and tax base, if it leads to a loss that is tax allowable, then the client will be able to make what year? A saving. The client will be able to make a saving. And then, of course, we have now what we call permanent differences. permanent differences are those differences that now do not result in a taxable amount or a deductible amount. The difference is basically not taxable totally. If the difference is not taxable totally, then whatever difference you get there, it will be permanent. It will never arise into any tax savings or tax payments in future. If, for example, ladies and gentlemen, RCM today was to donate, if we donate, in this case here, say Kenya shillings 50 million to some unregistered charity institution, we know that such donations are never allowed. They are never allowed. So if, for example, the accountant had taken this in the books as 50 million given by RCM, the taxman will not allow that. So the tax base will be zero there. And the difference between carrying amount and this tax base, 50 and 0, will be now 50. There will be a difference there, but that difference is permanent. Because even in the future, I mean, there is nothing that will be done for that amount to ever be allowed for tax purposes. So then that means that the difference is what here is permanent, So temporary differences, there are two: deductible, taxable. And then we have permanent differences. I believe with that, now, ladies and gentlemen, you've got something that you can really use to write something on your scripts. We don't want those scripts that students at times they give us in an exam where a student has not written anything totally, and then at the back here, they're coming to write that God bless the work of my hands. Oh Lord, bless the work of my hands. Which hands now? You've not written anything. You haven't written anything. Now, ladies and gentlemen, can I move on? Can I move on? Have you guys been able to pick something? Have you guys been able to pick something there? Yes. Yes. All right. Thank you so much. Now, explain 3 limitations of common size financial statements. You know that common size financial statements are those financial statements that will have percentages being written based on some common items. Like if it is a sales, or rather if it is income statement, the base will be the sales. So you take any item in the income statement, you divide by the sales figure times 100. So that in this case, you have now common size. They're normally given in form of percentages. I'm so sure you must have done this in your financial management especially. So those common size financial statements, what are their key limitations? Of course, the first limitation is that I'll not be able to see my figures, because the figures are given as percentages, not absolute amounts. As a businessman, there are those situations where I would want to see how much sales did I make. Don't tell me sales over sales 100%. No. So pretty fast, ladies and gentlemen. So we are told here, no absolute figures. Common size statements use percentages, which may not give a sense of the entity size or scale. You can't even compare this across industries. Comparisons between different industries are difficult due to differing cost structures. And then, of course, they ignore inflation because you see you are not putting in the amounts. And they ignore inflation. The analysis does not adjust for inflation, making comparisons over time potentially what here misleading. Ladies and gentlemen, that one I know you can easily cram and use it. The other day they gave us something on IPSAS 45. IPSAS 45, revaluation accounting under the current value model. So whenever we revalue our assets, my good students, it doesn't matter what name they call it. They can even call it IPSAS 572. It doesn't matter. So long as they just give us an idea. As an accountant, in accordance to IFRSs, whenever we revalue, like if it's RCM college, all right, we could be having a primary school somewhere, and we have, in this case here within the group, and we have this primary school having assets, and then we call in a valuer. who tells us, hey, this particular building is supposed to move from 40 million to 60 million. So there is a revaluation surplus there. There is a revaluation increase. What I was told by my teachers when they taught me, this revaluation increase can never be booked under P&L. They can't be put in our profit and loss statement. Because once you put this revaluation gain in the profit and loss statement, then the shareholders here will be able to say, hey, our profits have really grown. Our profits have grown. Give us a lot of dividends. Any revaluation gain shall always be booked under OCI, other comprehensive incomes. Whenever you hear about anything about revaluation, you must always remember that revaluation surpluses, revaluation gains shall always be booked under OCI, other comprehensive incomes. And of course, once you have this OCI, because of the double entry, you shall be able to have, in this case here, the revaluation what year? Surplus. So revaluation surplus will be credited here. Please listen, and listen to me very well. What if now again this person now comes later on and tells us that, you know what, this particular asset has done what he has reduced? So if it reduces, we shall use our revaluation surplus account. Any reduction shall be taken through the revaluation surplus account. You debit it. And that is it. Once you mention like that, you are a very clever student. You'll be able to even get an award. You'll be able to get an award. So whenever you hear about revaluation accounting, revaluation increases, they are normally recognized in OCI, other comprehensive incomes, and accumulated under revaluation surplus. Don't even bother reading about this, all this, they are useless. Don't cram this thing. Never cram it. You just take it the way I'm telling you. If it's a revaluation increase, the moment I see you've mentioned that this particular increase will go to other comprehensive incomes, that's a student who is really, really very, very far away. And then any revaluation decreases, they are recognized in surplus. They're recognized in this revaluation surplus. Actually, the best way is to recognize it in the revaluation surplus. Yeah, don't go talking about deficits. No, that alone is okay. Now, ladies and gentlemen, then we have this concept of IS 8, accounting treatment of changes in accounting what year. I love accounting policies in the years that I've done. In the years that I've done audit, I love audit. If I were you guys, all of you, if I were you, I would always wish to become an auditor. Auditing in this case is the best. Auditing is the best. Of course, when you clear your CPA, you can become a tax accountant, you can become an auditor. But the one that strikes me best is audit, because you get to know so many things. Like now, when you talk over accounting policy, you've been using a particular policy, yeah? And then come 2025, you feel like, hey, I need to change this policy. I've been working on revaluation of my stock using weighted average method, WAM. But now this time around, I feel like I should be able to value my stocks using FIFO, first in, first out. There is no problem. You are allowed. IS 8 allows you to make those changes, change your accounting policies. But when you change your accounting policies, if you have changed your accounting policy that you'll be using to develop 2025 financial statements, then the remember how the financial statements are normally put? They normally come in pairs, right? They normally come in pairs, like 2024, 2025. Yeah, pairs like this. So you'll be required in this case here to restate your previous year's financial statements. Actually, when I audit and there is a change in accounting policy for proper mirror of the operations, myself, I normally ask for 3 years. Yeah, so I'll ask for 2023, 2024, and 2025 to be put together, like, so I can see the Because whenever people are changing accounting policies, normally there is a possibility of creative accounting happening. People use these changed accounting policies to favor them. For example, people can change accounting policies. In this case, when they realize like their asset, they've been using, for example, revaluation model. Because revaluation, whenever there are revaluations, things look nice for a company when the revaluation is going up. But at times in this case here, these assets may start going down. And then I will see people saying, now I don't want a revaluation. Now I want cost model. I want us to look at cost model is the one where you take depreciations. You keep on subtracting depreciation for 1 year like that. Evaluation, in this case, you could be using this cost, but when you call in a valuer is able to take the figure even very high, very high. So no problem. If you think in this case, your evaluation model is the better model for you, you go ahead and do what here, you go ahead and make the changes, but remember the concept of backward thinking. We call it retrospective. Get the financial statements of the previous years and then do what year, change them. And then as an auditor, I must ask to see your opening balances. As much as we are talking of retrospective, as an auditor, I will ask for opening balances schedule under the old policy, under the new policy, because opening balances, people will always keep on, joking with things there, because most of accountants, instead of us being chief accountants, most of us, we are thief accountants. We help these directors steal money that belongs to KRA, steal money that belongs to other stakeholders. So we end up being thief accountants. But when you get, in this case, an auditor who knows their work like our and company know our job, we catch them by the day. We catch these thief accountants here by the day. We tell them, no, bring this and this. You get even situations where accountants run away. They run away before I finish my auditing. So accounting treatment of changes in accounting policies, are applied retrospectively. Adjust opening balances of each affected component, adjust opening balances, that's very good. And then of course there must be adequate disclosure of the change in accounting policy. In the notes, there must be adequate disclosure. I saw so many comments up there. Yeah, vertical analysis, great. 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 I see we are together. So can I continue, ladies and gentlemen? Yeah, even management accounting, if you want to pass management accounting round 1, ensure that you really are very good at these theories. And I'm available. You can book me. You can book me to come and just revise the theories with you. And I'm never very, very far away with the examiner. Yeah. Especially on these theories. After the exam, so many guys call me. They tell me, Mwalim, you said this, and this came. Yeah, it makes me happy because it's a way of me helping you guys. So can I continue, ladies and gentlemen? Can I continue? Let me get your feedback. Unfortunately, the intermediate students do not know me. Whenever I call for a class, they don't come many. If this class was a advanced level class, by now I would be having more than 500 students. If it was advanced level class, because they know me. Yes, we continue. Great. All right. This is very easy. Whenever I hear of IS2 inventories, first of all, I will always remember IS2. IS2 tells me what? IS2 tells me what? IS2, ladies and gentlemen, tells me something very, very good. That whenever I have inventory items in my store, I will value them either at cost, the cost that I incurred bringing them into my shop, or at the net realizable value, whichever is lower. whichever is lower. Sasa wewe umeenda ukapatana na Wakisii mahali. Wakisii wamekupatia very good bananas. Kisii are the best bananas in East Africa. Yeah. So kuna supermarket yako. So umeinika cost ya pesa ngapi? Maybe 5 shillings per banana. Ukachukua lori mzima, ukakuja ukaweka kwa supermarket yako Eastmart. Ile stock ya bananas umejaza. Kidogo kidogo you start realizing hivi vitu zinaiva haraka haraka, zinaharibika haraka haraka, watu wakunua sio wengi vile ulikuwa unafikiria, etc. And then card 5 shillings. But I realized that for me to be able to sell these bananas, I can only be able to sell these bananas if I sell them for just 1 shilling. 1 shilling. Only 1 shilling. So it means that I will look at 2 possibilities here. The cost of each banana is 5. But if I want to sell this, I can only realize 1 bob. IS2 tells me always to compare those 2 things and always pick the lower. Pick the lower. We always pick the lower. IS2 tells me how much did it cost you. What can you realize? Even minus the selling cost. Minus the selling cost. What we call net realizable value. Whichever is lower is what you shall be able to book in. Particularly that inventories in your financial statements. Ladies and gentlemen, they always keep on asking us about the various types of inventories. IS2 talks about what? Types of inventories. Of course, we have inventories in terms of raw materials when they come on board. We have finished goods, if I'm a manufacturing company, finished goods. And then between them coming and finished, in between there is work in progress. So when you look at inventories, always look at number 1, raw materials, work in progress, and then we have lastly finished goods. And then of course, if for example you are a factory, all right, you'll be having these maintenance things. You need bolts, you need so many things here. You need oil. All these more stuff for factory maintenance. Those ones also will qualify to be booked as inventory, So like now here they asked us scope of the time inventories as per IS2. So we have raw materials, we have work in progress, we have finished goods. For example, the cars that we have been able to finish manufacturing, automatically if they haven't been sold, they will be taken as inventories. And then we have maintenance supplies and the consumables held for production. Thank you. Measurement of inventories, I'll not even read this. Inventories are measured at the lower of cost and net realizable value. Yeah, lower of cost and net realizable value. Once you have that, then that will be very, 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 very good. Now, ladies and gentlemen, in terms of inventory disclosure requirements, remember you're going to have a whole area where you capture the disclosures on inventory. Yeah, you must tell us the accounting policy that was used. Is it FIFO or weighted average method? Remember, LIFO is no longer allowed. Last in, first out was abolished. So you could either use FIFO or weighted average. And then you'll be able to give us the total carrying amounts of inventories by category. All right. If it's finished goods, how much? Work in progress, how much? You must give us those things, ladies and gentlemen, like that. Then we have inventory recognized as an expense. For example, the director's drawings, right? Yeah. So as we take this amount, in this case here, to the director's account, we must debit our P&L. So inventories recognized as an expense. If there are any write-downs, like now I explained the concept of I incurred the cost of 5, but now I'm selling them at 1. You see, there is a write-down there. There's loss of value there. So if there are any write-downs, you shall tell us. But the most important thing whenever it comes to inventory, and we'll be able to see your financial statements, ladies and gentlemen, we shall always disclose accounting policies. We have to disclose inventory value by categories. And you must give us, ladies and gentlemen, any losses, any amount of write-downs like that. Don't forget that, ladies and gentlemen, as you go to your exam. I'm almost finishing. I'm almost finishing, very close to finishing. You can see we are on page 4 out of 6. Now, this question, you must have seen this question asked severally. The concept of IAS 19, employee benefits, 4 categories of expenses under IAS what year? 19. Very, very easy. Very, very easy. So when we talk about employee benefits, you shall always look at these benefits from the time these guys are working with you. Yeah. Then, of course, they either retire or something, right? So the first expense under your employees will book in what we call the short-term benefits. Short-term, like ourselves here at the college, we get salaries. We get bonuses depending on the number of students that you get. There's lecturers who are able to pull like 500 students, 400 students. You must give them some bonus, kind of. Then we have post-employment benefits, ladies and gentlemen. Remember, as we retire, we expect in this case here to get pensions here. So you as a company, you have to think about this post-employment through your actuary. You must do what we call actuarial valuations. Then we have other long-term benefits. These people who work for us like 30 years. We'll say if you work for us for 30 years, we shall give you a long service leave or even a whole year. Once you hit your 30th year, we give you a whole year, which you are paid normal pay, all right? That is something, if you have a policy like that, we have to think about. Long-term benefits, this could be like the options. What we call employee share ownership programs. So if it's RCM, we say, if you work for us for 30 years, as you disappear from the college, we shall be able to give you like 10% or whatever number of shares we agree under the category of employee shares. Then we have to always think about that. And then should we sack you, what happens? Whenever you, disagree, you've disagreed with an employee, remember it is about separation. You're not firing this person. You must separate amicably in good ways. So then you should be able to have what we call severance packages. Remember, don't judge this employee just by 1-day event, 2 days events, 1 month event. When you're sacking them, you create an enmity. No, these guys have served you. You will still need to give them some benefits. So whenever you talk over IAS 19 employee benefits, ladies and gentlemen, and I hope you're writing them somewhere there in a way that you'll not be able to forget, we have the short-term benefits, what these people will be earning all through before they retire, post-employment benefits, the pensions, other long-term benefits like the long-term service. Then we have termination. Should we sack you? What happens? Ladies and gentlemen, this is another question that has really, really been disturbing students, and yet it is the easiest. IFRS 15, the 5-step model. Remember, IFRS 15 is all about recognition of revenue from contract customers. Contract customers. They are those customers that you happen to be having a contract with. Yeah. Like if it is a Safaricom, assuming it's Safaricom, they can come and give you on the base of this internet. We are giving you this internet for the next 5 years. You'll be paying us this amount every year. And then on top of, for example, the wires, internet, etc., we're also giving you computers to help you run this thing. Remember, IFRS, if you remember very well, ladies and gentlemen, I can see a few comments there. I can see a few comments here. Whenever we talk over IFRS 15, there must be many components involved. So we have this person has supplied you with internet, and then he has supplied you with some computers. Whenever we talk of contracted customers, we are in most cases thinking about a customer that we are offering more than one commodity. More than one commodity. All right. Now, ladies and gentlemen, please listen. Allow me to read here. Allow me to read here before I read your messages. All right. So first of all, you must identify the contract with the customer. You as the auditor, you must ask, like if it's Safaricom and RCM, What is the contract drawn between the two? How does it read like? Now, from there, you'll be able to identify the performance obligations in the contract. What is it that the Safaricom is required to deliver to RCM? And are they delivering that? If they are not delivering that, then don't recognize that as revenue. So identify the performance obligations in the contract. Then now determine the transaction price. You're being charged, say, like 20,000 every month under this contract. And then now you as the accountant, have you been able to allocate the transaction price in between the performance obligations? Safaricom has said, it's giving us the internet. It's giving us computers. So out of the 20,000, how much should be taken to the internet and how much should be allocated or apportioned to the computers? Yeah, allocate the transaction price to the performance obligations. And then now you recognize revenue when or as the performance obligation is satisfied. When the performance obligation has been satisfied, then now keep on recognizing revenue like that. You may forget about everything, but me, there is something I can never forget. That first of all, there must be a contract drawn. In this contract, we expect clear spelling of the obligations, the performance obligations. What do you need to perform? So I expect a clear spelling. All right. All right. This 5-step model is very, very important. Assuming, for example, I was a young man in this case here who wants to marry. Of course, I'm not an old man now. So then we have in this case here our marriage certificate. Our marriage certificate should be drawn very well. And in this marriage certificate, we expect, ladies and gentlemen, the performance obligations to be put there. What is expected of me? This young lady, what is expected of her? Don't think that you are coming into this marriage. All right. So the performance obligations must be clearly determined there. And then there is the allocation. Sorry. Scratching sound. No, it's my internet. It is my internet. It is my internet. Let me know. Let me know once you guys are now able to hear me very well. I will not continue until you tell me now, Mwalimu, your internet is okay. Is my internet okay now, ladies and gentlemen? Now it's okay. Thank you so much. And I'm finishing in the next actually 5 minutes. Great. Thank you so much. All right. All right. All right. All right. So identify the contract with the customer. This could be like a marriage certificate. In the marriage certificate, ladies and gentlemen, we are saying that every party's performance obligations must be put there. Now that marriage certificate cannot continue now. We can only use our example of RCM and Safaricom. So then this internet and these computers, Safaricom, of course, will tell us every month 20,000. You must determine the transaction price, and the transaction price must be apportioned now to the performance obligations. If you can't do that, don't recognize the revenue. Ladies and gentlemen, in some way, have you been able to understand this concept of IFRS 15, the 5-step model? Have you been able to identify? Have you been able to understand the IFRS 15, the 5-step model? I can't see them giving me responses pretty fast. You know, they are 60 now. Yeah, great. Thank you so much. Thank you so much. Please ensure that you shall be able to apply that concept in your exam. Can I ask you another question? Can I ask you another question? Is there somebody who is seeing this theory for the very first time, that they have never seen this kind of a theory before? Or if they saw it before, they never understood it. Now they're able to understand it very well. At least I've seen one person. Ah, great. Then that means I'm adding value. That means I'm adding value, which really is good, which is good. I don't want to be here wasting your time and yet you're supposed to be reading for your exams. It's good to know that I'm here helping you guys. Now, on to my last page, they are talking about IFRS 9. This is some of those standards that are really, really feared. For nothing, for nothing, for nothing. Like now here they were talking about the recognition. You see, for example, we are supposed to know that IFRS 9, we are talking about financial instruments. We are talking about hedge. We call them hedges, like the fences. Yeah, great. Hedges. You know, ladies and gentlemen, it's always important for you to keep on protecting yourselves. I mean, this world is full of so many risks. Like Kenya Airways, a few years ago, they realized that they were putting in a lot of money into, fuel. So they decided to buy what we call a fuel derivative, like this, a fuel derivative. Yeah, it's a type of a financial instrument. So as a student doing this financial reporting, I will always be required, ladies and gentlemen, to understand the recognition and de-recognition. Because even if it's a financial asset, how will it be de-recognized? The recognition is about, ladies and gentlemen, the asset is no longer yours. If it's no longer yours, don't carry it in the books of accounts. This question will come. The recognition of IFRS 9 financial assets. How do we recognize them? Look at this. The recognition of a financial asset. An entity recognizes a financial asset from its books when either the rights to receive cash flows have ended. You will not receive any cash flows from this in the future. E.g., the customer has paid the debt in full. Or if you transfer this particular asset to another person, if you sell. Or number two, the asset has been transferred and the entity has transferred substantially all the risks and rewards of ownership, e.g. selling a receivable to another company without taking on the risk of non-payment. Doing in this case here what we call a non-recourse factoring. A non-recourse, doing what we call a non-recourse factoring. Please listen. I will share, yes, I will share. All right, please listen. You see, receivables is a very, very good type of a financial asset. So I have Peter Mwaura here. Peter Mwaura may be owing RCM. And then this is an example, Peter Mwaura. Things happen. Now Peter Mwaura is not able to continue paying our fees in the future. You see, what is an asset? An asset is any resource that we expect to receive cash flows from in the future. So then if there will be nothing forthcoming from Peter Mwaura to RCM in the future, why should I keep Peter Mwaura in my books? I should be able to recognize him. I should be able to remove him from the books of RCM. Yeah, because it's no longer giving me cash flows. Or at times, remember, ladies and gentlemen, for those of you who have been in business like myself, I mean, there are times in this case, we will get ourselves in some funny situation where we have so many people who are owing us money, all right, in the name of receivables, but we don't have liquidity, we don't have cash. What do? We look for a factor. So this factor would be like these people normally call you guys a lot when you take like Fuliza or whatever, and you're not able to pay. You'll get, in this case here, your accounts have been factored. They've been transferred. They've been transferred. They've been transferred in this case here to somebody different. All right. So the moment you have given your right to receive cash flow to somebody different, then you need to remove those assets from your books. So I repeat again, ladies and gentlemen, remember, Fatuma, my internet is quite bad, so I'll not be able to put my camera on. The most important thing is to understand the concepts here. So the recognition of a financial asset, an entity removes the recognized financial asset from its books when the right to receive cash flows have ended. The customer has paid, for example, the debt in full, or he has become bankrupt. He can no longer continue giving you the cash flows, or the asset has been transferred and the entity has transferred substantially. The asset has been sold, because that's the easy language. The asset has been sold. The recognition of a financial liability. Now, when in this case here, for example, ladies and gentlemen, you're also required here to be paying other people. But now you have paid your entire liability. Then you should be able to remove that liability from your books. A financial liability, ladies and gentlemen, is removed or recognized when the obligation is discharged, when the obligation is paid, or expires, e.g. legally ends after a set period. If a company pays off a bank loan in full, it recognizes the loan from its books. Ladies and gentlemen, I told you, I don't want you to be excellent in this. Excellence is a very costly thing. What I want you to do is just to master this thing in a way that will be above average, and if possible, in a way that will be able to explain in your own language. All right? And now, with your permission, unless you have a question regarding any of this, please allow me to go to question number 20. Question number 4. Question number 4. Question number 4. Now, this ipsas 23 together with ipsas 9 has really confused students in the past. ipsas 9 and ipsas 24. Oh, sorry, Fatuma. We shall overcome. We'll be able to get a link to this video immediately after this class. Now, my good students, please listen and listen to me very well. My good students, we are overcoming. That one I can assure you, we shall overcome. That one I can assure you, we shall overcome. We are overcoming. We are overcoming. Yeah, great. Now, I hope it's okay now. Now, ladies and gentlemen, please listen. We have what we call ipsas 9, International Public Sector Accounting Standard number 9. And then we have ipsas 23, International Public Sector Accounting Standard number 23. So ipsas number 9 is about revenue from exchange transactions. Revenue from exchange transactions. And then we have, that is ipsas 9. And then we have ipsas 23. So ipsas 23 is revenue from non-exchange transactions. When you go to the United Nations, you realize that United Nations, of course, they use ipsas, Yeah, even our, like Kenyatta Hospital, government sector, government institutions, they use ipsas to do their financial reporting. So like Kenyatta National Hospital will have two types of revenues. There is a revenue from government, there is revenue from donors, donations, and there is revenue being paid by their customers, patients. They pay a little bit, something a little bit, they go and pay across the counter. So then when they're recognizing their revenue, they must recognize two lines of revenue. So we have revenue from exchange transactions, and exchange transactions, you give me a service, I paid money. You give me a service, I paid money. That's ipsas 9, revenue from exchange transactions. You treated me, that is a service, and I paid you 2,000 shillings. We exchanged. The customer and this hostel exchanged things, service and money, service and money. In many situations, ladies and gentlemen, most of these government bodies operate under IPSAS 23, revenue from non-exchange transactions. They gave us money, no service was given to them. Like the government exchequer will transfer resources to Kenyatta National Hospital, and yet the government does not go to the Kenyatta National Hospital to be injected, to be treated, nothing. We have other donors from US, from UK, who will simply look at the stories happening at Kenyatta National Hospital, and they'll be able to send donations. They will then be able to have a line where they talk about IPSAS from non-exchange transactions. Revenue from non-exchange transactions. Even in the UN, you'll be surprised to UN, for example, the member countries are able to do what here? The member countries are able to give donations to the United Nations, and the United Nations does not give them anything in return. That's why you're calling them donations. But if you go to the UN, especially before the Al-Shabaab, they used to have a very, very good, beautiful field, which they used to hire out for purposes of what here? People doing conferences, weddings, very beautiful field, very beautiful grounds. And they used to charge lots of money because of the ambience. All right. So you see now in that particular case, United Nations here, UNEP at Gigiri, they used to receive money. And they used to give a service here. At times in this case here, they are able to sell their research journals. They sell. So the people they sell to, they are buying a book and they're giving money in exchange. So then they should be able to always, under international public sector accounting standards, they need to recognize those two types of revenues. They need to recognize those two types of revenues. Now, what is the question asking about? They simply wanted us to give them IPSAS 23, revenue from non-exchange transactions, recognition of an asset in respect of taxes. So remember, this tax has just been promised to you. All right? So as an entity, as Kenya, for example, here, how do you recognize this cash flow that will be coming to you in the form of? So there are first of all conditions. An entity recognizes an asset, like this particular tax asset, when it has a legal right to collect the tax. The taxable event has already occurred, like the tax income for last year. The amount can be measured reliably. If you can't measure the amount reliably, then you cannot recognize that as your asset. The taxable event has occurred, and you have a legal right through these things that you normally see. These people talking about finance bill. You have a legal right to collect the tax. Otherwise, you cannot recognize that as your asset. Then the term transfers, these are very easy. These are the donations now. Yeah, the term transfers, explanation with the examples for marks, transfers are inflows of resources from non-exchange transactions. Example, we have a government grant. The government simply gives you money. Donations from foreign agencies, etc. So, ladies and gentlemen, should they bring a question on IPSAS 23, do you think you are at a position of answering it very well? Do you think you are at a position of answering it very, very well? Do you think you are at a position of answering it very well? Do you think you are at a position of answering it very well? IPSAS 23, very good, please, very good, very good. And then on the last item here, this is very easy, it keeps on coming, every now and then exploration. You must have heard of exploration of mineral resources in Turkana. Exploration, IFRS 6, exploration and evaluation of mineral resources. This could be like the oil, like the diamond. It is exploration. So measurement principle. Exploration and evaluation assets are measured at cost initially, including acquisition, topographical studies, and drilling. At cost, how much do you incur? Indicators for impairment. Rights to explore has expired or will not be renewed. No budget or plans for further exploration. Data indicates that the asset will not generate sufficient economic benefits. Allow me to explain something small regarding this before we go to something different. I remember the time in this case here, I was doing a borehole for the school at Isinya. RCM has some assets at Isinya. Yeah, so then, of course, I'm an auditor, but at times in this case here, we also seek for clarifications. All right. So like now this borehole, how much in this case here should we be able to bring the entire borehole at to our books? It's very, very easy. I mean, on doing research, we realize that this concept of explorations, when you're drilling, it shall always be at cost. You've called in this case here, the drilling company has given you a budget, told you we shall be, so the cost you incur, 5 million down. Then in this case here, we have the rigs, we call them the rigs, etc. All right. You need some tubes. You know, you can't, for example, just leave it naked like that. There are things you must do. You need a pump. How much does it cost you? You need, in this case, the water towers up there. You need the pipe work now to take this particular water to wherever you want. So whenever we talk of exploration and evaluation, we must always take these assets here at cost. The cost, including any acquisitions that you have, if you have to acquire a few things here and there. Like if it is this particular bowl that I'm talking about, you must do some research. Yeah, because these people must come, in this case, this topographical thing, they have to look at what points in this case here could be having this water here. You pay about 50, 60,000 for that. So that must come in at the cost, as a cost. And then, of course, like you heard of Tullow Oil Company, this British company that is doing drilling over oils in Turkana. The company has not been successful. And they are taken because of hope. They are taken, in this case here, their assets to really have high value. Because they thought, Turkana was to give them, through the exploration, they thought Turkana would give them millions and millions and millions of liters of oil. But on reaching down there, they were not able to do much. They were not able to get much. Again, you know how our Kenyan government behaves. These guys, they started getting advances in terms of people wanting a bribe that will not be able to renew these licenses for you. So what happened, if you read their case, like right now they are selling all their wells, all right? But they have to do a big write down. They have to do a big write down of their asset exploration asset. So that write down of assets is what we call what here? Impairment, because you can't get enough cash flows from them. You have issues. You have this politician who has brought members of the Turkana community to sit on the road so that whatever small you've been able to basically get from down there as oil cannot be transported from Turkana land. And it goes on for 3 months, for 5 months. So you're not able to sell. You can't get those cash flows. So then you as an accountant, what will be able to show you that for sure this asset needs some impairment? Remember, impairment loss equals CA minus RA. CA minus RA. Carrying amount minus recoverable amount. All right. So you can see in this case, they have given us various indicators there. The right to explore has expired. Or somebody like Joe comes and tells you, finish. If you finish, once you finish, you'll not get any license. So automatically that means what? Yes, stoppage of your cash flows in the near future. Then that means that you should be able to impair your asset. You start telling the stakeholders that, hey, there is a danger ahead. Or if this particular company like Tullow Oil, they say now we are not going to do any further exploration. We are tired, no budgets or plans for further exploration. data indicates that the asset will not generate sufficient economic cash flows, economic budgets here. Then we have in this case here again another question. There are only two types of questions that can come under IFRS 15, those 5 steps. And then we have here these benefits of an asset. The benefit of an asset may be obtained when the customer has a legal title. The contract has to be there. The contract has to be there, right? The customer has physical possession. I have a logbook and I'm the one in this case here who holds these cars. The customer has accepted the asset. The customer has the risks and rewards of ownership. So if this car is serving them very well, they get rewards. Although at times in this case here, it will also put you into danger, risk. The entity has a right to payment and the customer has an obligation to do what here to pay. You may not be able to remember everything, ladies and gentlemen. Remember the benefits of an asset. You can only talk of you having this asset. This asset is yours if you have a contract, if you have a possession. Even if you don't have possession, on just a short call, you can call and say, bring this asset here. And it is brought to you. Your auditors can come and say, hey, today all these buses are yours, but we want you to stop operations for us to count them. If you are able to do that, then you have the right. All right. And then, of course, the customer enjoys all the dangers and rewards of what you don't have to remember all of them. At least you need something. Then we have here IS 26, statement for retired benefits. And the last thing, I suppose, no. So the statements for retirement benefit plans, whenever you have these retirement benefit schemes in your company, you must give us a statement of net assets available for benefits. So two things, you'll give a statement of net assets and a statement of changes in net assets. So you give us two things. You give a statement of net assets available for benefits. This is what we call balance sheet in our normal business. And then statement of changes in our net assets is what we call a P&L. P&L. So a statement of net assets available for benefits, which shows assets, liabilities, and net assets of the plan. And then a statement of changes in net assets available for benefits. It tracks additions, contributions, deductions, and investment incomes and losses. So contributions will be like the revenues. Deductions, what have we paid outside there? And then, ladies and gentlemen, we have what we call IPSA 17. So this is the last one for today. I don't want to be too much for you. Remember, there are those assets of heritage. Even in Kenya, in this case here, we have them. Like the Kenyatta's mausoleum, monument, all right? That is a heritage asset. And so many assets that even people travel from various countries to come and just see them. We take pride in them, all right? We don't have them there for purpose of selling them. We want to hold on to them forever. All right. So whenever we talk of heritage assets, and this has also been factored in, if you look at your exams, you'll be able to see these heritage assets are items of cultural, environmental, or historical significance preserved for future generations. Preserved for future generations, e.g., museums, historical buildings, monuments. Characteristics of heritage assets, 3 marks, held for public benefits, not for economic gain, really. Yeah, public benefit. Irreplaceable and often cannot be reliably measured. Like now the Kenyatta's mausoleum, I mean, how much will you be able to attach? But you know, there are people who travel from all the way UK to just come and see that. It can give you tourism income, but you can't say really that it is there for gain. No, we simply want to have them there so that our great-great-grandchildren will be able to see, I mean, where do we come from, etc., etc. Subject to legal or other restrictions on disposal. There are those heritage assets, ladies and gentlemen, if you want to sell them today, you can't just wake up and sell. No. Even, for example, some trees on your farm that are of heritage, you can't just wake up and sell. So if you must sell them, then there will be some legal avenues that you have to use. So, ladies and gentlemen, I've shared this handout with you, and I will be coming back later to simply take you through what we call cash flow statements. But before I teach you the cash flow statements, I will share with you 2 links which I would want you to watch. You go through those 2 videos and then we talk. If we do like that before your exams, you guys later on, you'll be calling, thanking me in a big, big way. Otherwise, it's been a pleasure hosting you this afternoon. I'm looking forward to meeting you later in the day. Thank you so much and bye. We shall overcome. You'll see in the group. In the group, I'll be able to tell you the time. Bye. Yeah. So I'll be able to tell you in the group the time. Thank you. Somebody saying I owe them. Who is this that I owe? We shall overcome. Do it continuously. We shall overcome. Okay, great. And of course, the students who are following me on YouTube, I expect you guys to do the honorable thing, which basically is subscribing, commenting. Thank you so much. Bye. Okay. For intermediate MA. Okay, fine. I hear you. Name of YouTube, Joshua Aura. Or Regina, you can reach out to me. You can reach out to me. The link I'll be able to share.